trading style is not so much an individual thing, but it depends on what type of trading you're doing and what type of instrument you're doing. So for example, if you're a market maker and you're making two-way prices in foreign exchange, it's a completely different kettle of fish than if you're a small-time speculator occasionally going in and out of the market and trying to pick up some pennies. Okay, so from then on, everything you do is like chalk and cheese, completely different. So over the years I have been occasionally a market maker, not terribly often, and that's really hard work. And you've got to be absolutely on the ball and knowing exactly what everybody else in the market is quoting for that particular instrument. A good example at the moment would be, say, if you're a market maker in Greek bonds. I mean, this is really tough. You have pretty much no idea of whether there are any bids in the market whatsoever. And you know that there's probably an awful lot of sellers out there. So you're going to be shading your prices all the time. The strategies you're going to use are very, very different. Whereas if you're just a small-time, dollar-yen trader and you sort of snatch and grab a few pips every day or something, it's just completely different. Your time scale is going to be different. You don't have a stock of goods that you've traded with. This is another thing as a market maker. You'll have in your toolbox, you probably have a stash of some of the actively traded shares, or certainly a good source where you can borrow them from where you need to. And by knowing that, then you know what your bottom line is and what it's going to cost you. So that's number one. Number two in my trading style, I'd say it depends on whether I'm trading on behalf of an institution, be it a bank or a hedge fund or a pension fund, or whether I'm trading as a private individual. And to me, these are two completely different things. So when I'm trading on behalf of institution, I've got to make enough money for the institution, who will then pay me a salary after profits, who will then hopefully pay me a bonus if I've done well, and then I pay the taxman a whole lot more. So do you see what I mean? That's one, it's a completely different income stream when if I'm using money that I have saved from all of the above, then how am I going to position it? And I tend to find that I'm exceedingly cautious with my own personal money, because I know just what hard work it was to get it in the first place. I've done all the trading, the day trading and the whatever in the day job, and then to have savings, I really don't want to fritter them away. So I'm extremely cautious. I tend to be very long term, much more so than on the day job. As I say, I have the investment horizon, as I call it, for my personal account trading and my trading as a professional capacity, and they're two completely different things. I'd say what I am is classic Dow theory. This was ideas postulated by Charles Dow, one-time editor of the Wall Street Journal, the man who invented the Dow Jones indices. And he sort of put the body of knowledge of technical analysis together. He didn't invent it, but he just sort of put it together. And I'd say on that, so number one are the charts themselves and their patterns. Absolutely key, number one. What I've then added to that is the candlesticks themselves. They give far stronger patterns than the bars, and so I like those a lot. They're really good. Moving averages I use, particularly the ones that form the cloud theory. I use those all the time. I love Fibonacci retracements. I love some oscillators some of the time. The reason I say only some and some of the time is that I find they put me one step away from the market itself. And the thing that I'm looking at my charts for is the measure of psychology and above all fear and greed. And the charts give me the purest key to that. And the oscillators are kind of a mathematical construct that sort of dissipates the power of the message. For that same reason, the psychology of the market, I love volume. Very, very important. Volume and open interest. Very much as a sort of backup to my views on the levels of fear and greed currently in the market. And option volatility. Volatility, implied volatility, is itself a fantastic gauge to work out which way round people are and what they're worried about, i.e. how much are they willing to pay for insurance. So it is a completely unique data set in terms of your analysis. Likewise, the other data set that's completely unique and often ignored are opinion polls. Properly conducted opinion poll data is again a unique measure of market sentiment. So you can see it in things like, you know, this year, yet again, every single pundit out there was forecasting that the US dollar would strengthen and that US interest rates would rise. All 64 out of 64 people polled by a news organisation said so. Well, there's a saying, if everyone's thinking the same way, somebody's not thinking. And there you have it, absolute concrete example.